Welcome back, everyone. Now it's time to dive straight into the heart of Crystal Gazing 7.0 with our first session of the day titled Decoding Market Signals, Noise, Narratives, and What's Next. In today's fast-moving environment, markets are influenced not just by fundamentals, but by headlines, liquidity flows, geopolitical shifts, and powerful narratives that often amplify short-term volatility. The key challenge for investors is to separate enduring signals from temporary noise and to understand what truly matters for the next phase of the market cycle. So this session aims to bring clarity to that process, identifying the indicators that deserve attention and the distractions that should be ignored. To lead this discussion, we are pleased to have with us Mr. Chokalingam Narayanan, Senior Fund Manager, PMS Equity at ICICI Prudential AMC. He comes armed with over 17 years of experience across fund management and investment research. Mr. Narayanan brings deep expertise in analyzing business fundamentals alongside macroeconomic and financial market trends. And over the course of his career, he has been associated with reputed institutions such as Baroda BNP Paribas Asset Management India, Deutsche Equities India, and Batliwala and Karni Securities. He holds a postgraduate diploma in management from TA Pai Management Institute, Manipal, a Bachelor of Commerce from G.R. Damodaran College of Science, and the FRM certification from the Global Association of Risk Professionals, USA. With his experience across multiple market cycles, we look forward to his perspective on what investors should focus on in the current environment. Mr. Narayanan, the floor is all yours. A very warm welcome to you. Take it away.
Thank you, Aishwarya, and good afternoon, everyone. Thanks a lot for the opportunity to PMS AIF World for this time, and thanks for logging on to all the viewers. I'll try and cover the first session on decoding market signals, noise, narratives, and what's next. So when you kind of look at I'll touch upon who we are. I represent ICICI Prudential Portfolio Management Services, part of ICICI Prudential Asset Management Company. We work more like a boutique within an institution. We bring together all the facets of an institution in terms of framework, in terms of risk and compliance functions, sales support, research function, and fund management. But along with it, we bring in the boutiqueness which is required for a product like portfolio management services, as well as alternative investment funds. That boutique nature is brought in through our unique way of bringing in concentrated portfolios, long-term orientation, and deep research work that we bring to the table. About the team, headed very strongly by a very seasoned team by Mr. Anand Shah with over 25 years of experience. I head the pure equities part of the business. Along with me, I have Gitika, Prem, Sandeep, Ankur, and Paul, each with over almost between on an average we have between 15 to 25 years of experience. So it's a fairly seasoned team in that sense, which is handling investors' money. With regards to about us, today we are the largest PMS outfit in the country with almost about 38,000 crores of long-only strategies under management. This is both PMS plus AIF. And then private capital is another 7,600 crores roughly, and long short strategy of another 1,300 crores. So in that sense, it's a fairly formidable franchise that we kind of have. Our belief, underlying the entire equity franchise out here, is that companies create wealth, not markets. While our all along as a AMC, we've been big proponents of asset allocation. When investors look at PMS, they are predominantly looking at on the equity side, how to think about it. So we believe that asset allocation is actually done by the investment partners, the distributors, and the advisors, and then only the equity portion of the money kind of comes to us. So when we kind of focus only on the equity portion of the money, we are very, very clear that instead of focusing too much on what the markets are offering, if we focus a lot more bottom up, we've historically seen companies create wealth. I'll illustrate this, more lucidly with data. So this is actually quite long-term data. The reason we've taken 5-year rolling periods out here is concerned because equity, as you all know, is a higher risk asset class, and with that, it kind of brings with it the level of volatility that comes along with it. Because end of the day, we are part owners in companies as an equity shareholder. So in that sense, whatever the inherent cash flow volatility that comes across to a business, that also gets transferred to the owners of the company. So in that sense, we have to look at it more from a longer term perspective. And if we can take a more longer term perspective, then what we've historically seen is that the markets also tend to give you a decent investment experience if you were to kind of give that longer term orientation. Just for example sake, we've kind of taken a 5-year period. It could have been a 4-year period or a 6-year period, but just for simplicity, we've kind of taken a 5-year period. And if you kind of look at what's happened, the bottom row is the returns as far as Nifty 500 is concerned for that particular year, and that returns actually remain quite volatile. But when you kind of take a 5-year period and look at what's the rolling returns for each of those 5-year buckets, you will see a very, very interesting phenomenon. And the reason to also take Nifty 500 is because you have the top 100 companies, which are the large caps, the next 150 in terms of mid cap, and the next 250 in terms of small cap. So it contains all market caps, within this. And when you kind of look at what's the dispersion of all these names in terms of what sort of returns that they've kind of generated over this rolling 5-year periods, what you will clearly see is that the lowest number of companies that have generated the highest return bucket out here is greater than 15%. And there, if you kind of see the lowest number of companies that's been there is in any 5-year period was in 2012 at 77 companies, and the highest has been 385 companies in 2024, which effectively means anywhere between 15 to 77% of the NSE 500 companies actually give you this kind of a return, or have given you this kind of a return, in the long run. This is a very, very healthy number, and it kind of tells you that if you're bottom up and if you're slightly more longer term oriented, then it actually you improve your chances of giving yourself a very decent investment experience, as long as you remain with this kind of construct. Now, again, how do you do that? It's very simple. Again, price is equal to EPS into PE. So for price to do well, you need earnings growth to be good, and you need PE re-rating to kind of happen. Now, how does that kind of historically happen? Again, we've kind of deconstructed this data from the previous 2 slides, and when we look at that, it's again a very, very telling outcome. So when you look at the companies in the same buckets and the NSE 500 companies over the same time frame, what you clearly see is companies that have delivered very good returns have also delivered very good earnings growth, which is basically the formula that we kind of saw in terms of EPS into PE. So one is profit growth. The second is the proxy for PE re-rating typically tends to be ROE. The reason is, if ROE tends to be better, then people are willing to pay a better multiple on that business. So, which is why it's important to look at the proxy of ROE. And if companies have managed to maintain high ROEs over a very, very long time frame, then essentially we've identified a good company, a company with good earnings and good ROE. Now, if you got these 2 attributes, then we've identified a good company. Does it necessarily become a good stock? Not really. So you also need to be very, very choosy about what is the sort of risk reward one pays for it. And in the long run, what we've historically seen is, if you get the combination of these 3 factors, that is what works. And that is where when you kind of for a good company to become a good stock, if you marry those two attributes along with the right risk reward, then you give yourself a really, really good chance of good wealth creation in the long run. Now let's see what happens if you don't get all three right. If you just get earnings growth right and the risk reward okay, then what you essentially see is that the ROEs are actually drifting down quite a lot. So in this case, the re-rating really doesn't happen too much. So you make okay sort of returns. But when you actually see the more telling data is actually the third bucket and the fourth bucket, where you will essentially see that those sort of companies actually don't have earnings growth. Neither is their ROE trending in the right direction, and the starting point of valuations also don't seem all right. So if you actually look at the starting period, the ROE is actually pretty high, but then the starting point of valuations has been very high. But if the direction of that has trended down in the wrong direction and the profit growth is not there, then it is actually a recipe for disaster, and you actually destruct a lot of wealth. So, which is where it's very, very important that one stays very, very process oriented, very disciplined about how one constructs a portfolio, and avoids this bucket of companies which are in the bottom two rows, and focuses as much as possible in the top row, and which is not a small number. If you kind of look at a 18-year time frame, you will kind of see that a good 28% of the companies have delivered this kind of a combination and outcome. So in that sense, it's actually a pretty decent number. The number actually oscillates between 15% to 77% with an average of about 28%. So which is where we kind of historically have remained focused on these attributes and being very, very process oriented. Again, coming to this, let's look at what's really happened over the last 15 years. And the reason to pick this into two phases: phase one is when the interest rates globally went really, really low, and at that time frame there was a lot of uneven competition which kind of came in, and as a result, higher margin businesses got disrupted faster, because typically when you have cheap capital, businesses with higher capital tend to get disrupted faster. They see higher competition come in, and which is where historically the B2B businesses got disrupted in that particular phase. And phase two is the period when actually you started to see the reversal of that. When the world started deglobalizing to some extent, you started seeing onset of multiple supply chains instead of one large global supply chain. So in this phase, when you kind of club the various sectors and how they perform, you'll kind of clearly see in the first bucket a lot of consumer-oriented businesses actually did very well, and they outperformed the markets very, very healthily. Export champions did very well and delivered better than the market, and also the longer-term macro trend beneficiaries also did well. But when you kind of come to the phase two of it, but in phase one, the capital intensive businesses actually went through a very, very tough time, and a lot of them actually struggled. This is despite the fact that nominal GDP during this phase actually did very well. When you kind of look at phase two, you would see that this was the resurgence of the B2B businesses, because world after COVID kind of changed. It was kind of a turning point in the sense that people realized that we can't just depend on a just-in-time inventory. We have to be also built. Supply chain also has to be built in for a just-in-case scenario. So which is where the entire narrative kind of changed, and different bucket of companies did better. But even if you kind of look at within these phases, it's not always been a single linear move. These have also had sub phases, and when you kind of look at those sub phases, even within that, you've had different dispersions. So phase one is basically coming out of COVID. Phase two is around the general elections in India, when you kind of had a little bit of uncertainty about whether there'll be policy continuity or not based on the election outcome. But then once the state elections, started coming through with 5 out of the 6 states being won by the ruling alliance, I think the confidence started to come back, and then the markets realized that policy continuity will prevail, and which is where you've started to see again a different set of companies do well. So net, what we're essentially trying to say here is you will have different set of companies doing well in different market cycles and different phases. But underlying all these, what we really need to do is be very, very bottom up focused. And if we can do that, then it really, and give ourselves a bit of time, typically a 5-year period as far as equities is concerned, then we are giving ourselves a better chance of giving ourselves a good investment experience. So that's the reason that our inherent investment philosophy has been companies create wealth, not markets. And how do we do this at ICICI Prudential Alternates business? When we kind of look at it, we have our own investment philosophy called BMV, which stands for Business Management and Valuation. It's a very, very simple framework evolved over a fairly long period of time, that we've kept improving upon it, kept iterating upon it, because situations change, scenarios change, managements change, the circumstances in which they respond kind of change. So that's where we kind of look at it, looking at all the cycles. We've kind of evolved it and made it more sound. It's not that this is a bulletproof strategy in the sense that it can't fail. It is. It does have its areas of concern from time to time, but we do believe that when we make mistakes, it allows us to refine the model and over a period of time make it more stronger and stronger. But essentially, what we've kind of realized is the fact that if we keep sticking to the investment philosophy and making it more sounder, then the chances of giving ourselves a better investment experience actually improves quite a lot. So which is how we've done it. And typically, the way we've kind of built a portfolio and done our investments at ICICI Prudential is through this 5-stage process as far as building a portfolio for the PMS investors are concerned. So in India, roughly about 2,500 stocks are getting actively traded. From that, our team today roughly covers between 620 to 650 stocks, including some that are listed outside India, and including some which are in the REITs and InvITs and those kind of instruments. So when you kind of look at that, this gives us unparalleled coverage on the Indian equity markets. Even if you kind of look at the largest broking house in the country, doesn't cover more than 400 names. So in that sense, having an in-house research team, which is a huge advantage for us, allows us to cover day in, day out investment research on over 620 companies in the Indian equity markets in the country. So this is again, this is a really big backbone for us. This is the first level of filtration that the research team does. From there, then we use a BMV framework and filter out the companies. So here also, if you kind of look at it, it kind of gives you somewhere between, today we have about 170 to 190 companies today that kind of meet the BMV filters and comes through. Now, if you kind of look at this data, this again kind of corroborates to that 28 to 30% number that we earlier talked about. In that sense, in the long run, there's a decent filter to kind of keep looking at it, keep working on it, and iterate. So when we look at that, roughly about these 170 to 190 companies become the universe from which we start to then deploy our strategies and construct portfolios. Now, these 170 to 190 odd companies is what is there across all our strategies. But then we run different strategies depending on what are the investment needs, what are the investment goals that the investor wants to achieve over a certain time frame, what is their investment horizon, what sort of risk appetite do they kind of have during this phase. So depending on all that, we have uh, uh, a wide variety of products that suit every investor's needs. So it's like a supermarket in the sense it's like a financial supermarket that we kind of run strategies and solutions that are attuned to the investor's needs. So when we kind of look at the strategy level filters, let's say for example, two of our most flagship strategies are Contra and Pipe. I'm just taking it as an example. The reason is if you look at Contra, we typically run three types of businesses under that strategy. We run out of flavor leading companies. We try to pick special situation names, and we also try to pick underappreciated growth stories under that strategy. But predominantly in that strategy, the flavor tends to be more out of flavor sectors and leading companies. So whatever set of companies that fit this criteria from the 170 to 190 kind of get filtered into this step. And in case of Pipe, for example, it's a predominantly a small cap strategy. For example, whatever small caps that filter through kind of then get evaluated to the next stage. So that number is between 65 to 75, for instance. And then from there, then we effectively then build a portfolio. Now, this portfolio, in case of a Contra, given it's a flexi cap strategy, for instance, we tend to run between a 25 to 35 stock portfolio. But in case of a small cap strategy, we tend to run between 35 to 40 names in the portfolio. The reason for running these kind of, slightly, you would say between 25 to 40 names, depending on whether it's a flexi cap or a small cap product, is that when you kind of look at investment studies with done, what you clearly see is the right level of diversification for a market like India kind of happens to be around these levels, and that's the reason that we've kind of remained at around these levels as far as building the portfolio is concerned. So this is how we kind of build a effective portfolio as far as the PMS strategies are concerned. Now, outlook for 2026, having covered our process, which is the backbone of what we do, because that really differentiates us in terms of the rigor, in terms of the discipline, in terms of the backbone and the breadth of coverage that we bring to the table. That really sets us apart. That's the reason to cover that aspect, first. Now, coming to the outlook, we are coming with a backdrop where the Nifty 500, for instance, in terms of US dollar terms, hasn't returned much, in the past 1 year. When you kind of look at the calendar year 2025, Nifty was in fact one of the few markets that actually was flattish. But literally every other market that did well, particularly were big beneficiaries of AI. So whether you look at a Korea or Taiwan, these were big beneficiaries of AI, and they had predominantly one or two companies that dominate those indices with almost a 25 to 40% sort of weights. Also, in some cases, given the level of outperformance that some of those large businesses have done in those countries. So in that sense, there've been more narrow rallies in those markets. Whereas when you kind of look at other markets where things have done well, they've otherwise been beneficiaries of the AI, value chain by being commodity suppliers, like say for instance Brazil is concerned. So that's how when you kind of look at what's really happened, markets which have done well last year have been within that. As a result of India not having done well globally, also there is this trend that asset gets allocated a little bit with a bit of return chasing attitude, not only in India but globally also we do see this. And given that returns in India have been moderate over the last 18 odd months, we have seen the foreigners not participating, and in fact, going underweight India in as far as emerging markets as well as global markets are concerned, and reallocating that money to better performing markets. So as a result, given the flows that were there, as well as uncertainty around the trade relations with some leading global powers, we had the currency actually not doing too great. In fact, the currency was one of the weakest, and from being slightly above, as far as currency on real effective exchange rate is concerned, it actually became very, very, undervalued. This is despite the fact that the balance of payments and the current account surplus actually current account balance actually being very, very balanced, and India's fiscal actually being decent. So when you kind of look at what's happened with regards to the corporate profit to GDP, which is a clear indicator of how the corporate sector has kind of done, which is what we are bothered about as equity market investors are concerned, you will kind of see that the corporate profit to GDP has actually come back to the peaks, and in fact it's kind of normalized. The reason for this is one underlying aspect is this is kind of a mirror image of the US interest rates. So as the interest rates have kind of settled at a higher level, given the inflation levels in the world, you've started to see more respect for capital coming across, and as a result, you've seen profits settle at a better level. And within that, when you kind of bucket the economy into three different buckets, one is cyclical and capital-intensive businesses, second is defensives, and third is financials. What you'll clearly see in the long run is after the global financial crisis, the profitability of the cyclical and capital-intensive businesses were under pressure big time, and they really saw a lot of wealth destruction. As a result, the financial entities which funded them and their capex also suffered, and they also did not create as much wealth. But when you kind of look at defenses, they've been steady all along and they've done reasonably okay. But then their valuations went up for significantly in the period between 2010 and 2020, and which is where the setup for them has not been that great over the last 5 years. But as we have come out of COVID, the resurgence in profitability of the cyclical and capital-intensive businesses has been quite meaningful, and as a result, the asset quality pain also in the financial side has kind of turned around, and that's also done well. So when you kind of today look at the markets on a bottom-up basis, you're actually able to find opportunities across the three broad spectrums of the market, not just narrow area of the defensive sectors, which we saw between 2010 and 2020. This is a very, very interesting and long-term oriented chart. When you kind of look at it, it's a very, very self-explanatory and powerful data. The first graph is GDP in nominal terms. The second graph is profit growth at a corporate level, and third graph is market caps of the Nifty 500. When you kind of look at between 2010 to 15, GDP grew grew at about 14.5%. Corporate profits grew at about 6%. Market cap grew about 12%. The reason that market cap grew slightly ahead of profits was the reason that interest rates globally went down. As a result, there was a little bit of re-rating, which kind of led to the market caps kind of moving up higher. But when you kind of look at versus nominal GDP, the profit having come down, that was largely on account of the fact that because interest rates came down, there was a lot of uneven competition and profits came under pressure. And we had the continuation of that in a more pronounced manner between 2015 to 20. So if you kind of look at 2015 to 20, you will see that GDP actually grew by 10%, but profits merely grew 1.1% CAGR. And markets also responded with only a 2.9% CAGR. So this period of underperformance actually set in the base for the period for 2020 to 2024 is concerned. So when you kind of look at that particular phase, while the GDP kind of continued to grow at 10 odd percent on nominal terms, the profits really rebounded big time by about 35%. And as a result, the markets also kind of returned a good 35% in sync with the earnings growth that the corporates kind of offered. now 2024 to 26 having normalized with regards to profitability is concerned, while the GDP kind of continued to grow at around the 9 to 10% handle, the profits grew at about 7.3%, and market cap went up by about 11%. So essentially, we are now in a normalization phase. So where what I'd like to kind of highlight out here is we are not in a phase where we see outsized returns as far as like 2020 to 2024 is concerned. We are likely to be in a period where normalized returns are likely to come. We see a economy growing between a 10 to 12% handle, earnings kind of growing around the 12% handle, and market caps hopefully kind of keeping in sync with that. You will always have a bit of lead and lag. So don't expect the 2020 to 2024, but be having expectations which are more normalized. The other facets of the economy continue to be very, very solid. The working age population kind of continues to offer longer term growth runway. The distribution of incomes is improving. The affluence and the disposable income aspect is improving. Larger sections of the population is moving to this side. So that offers a decent opportunity. The government has done a fantastic job of consolidating the balance sheet. And today, when you kind of look at the central government balance sheet of 4.4% of fiscal deficit and 2.5, 2.6% of central state government fiscal deficit, we are actually in a very, very healthy shape. The bright spot as far as the economy continues to be net services exports. They've lent a huge area of support when the trade deficit has been slightly higher, but the trade deficit is actually in areas where we are starting to re-export, so we are not really bothered about. The quality of the trade deficit is actually quite decent, and services exports and repatriation of money from the diaspora is offering decent amount of stability to the Indian fiscal and the balance of payments situations is concerned. And when you kind of look at the policymakers, they've been very conducive about spurring growth in the economy, and they've kept liquidity levels quite easy, and they've also cut down interest rates into an attractive level where growth can kind of start to pick up. Corporates, when you kind of look at them, their revenues are picking up at a better pace. Profitability is actually improving, and cash flows have started to improve. And the resurgence in operating cash flows and the good markets have meant that there is risk capital available. And today we are seeing a pickup in private capex. So private capex is, instead of a 5% growth that we saw between FY12 and 19, between FY19 and 25, today we are seeing a 14% CAGR. So this is a very, very healthy outcome which can sustain the longer term growth runway for the corporates is concerned. So one takes comfort with that. The balance sheet of the corporates is also quite solid and very healthy. Net, when you kind of look at what's likely as far as profit growth is concerned, because net, end of the day, you need earnings growth to kind of back it up, because at the end of the day, stock price equal to EPS into PE. EPS is starting to come back, which is quite healthy. PE, it's always difficult to say where it settles at. There'll always be a little bit of lead and lag, but as far as we are staying bottom up is concerned, I think we improve our chances, and that's how we'd like to focus. And even looking at forward numbers, the growth rates seem to be quite decent. And in that sense, we remain quite constructive about the markets. The backdrop has also got slightly more positive over the last month and a half, with the conclusion of a few FTAs. At least the framework agreements have been concluded. Now we need the conclusion on paper to be done, particularly on the US trade deal and the EU and UK markets. These are large markets which, if opened up to the Indian corporates, we can see a resurgence even from here. So that's a pretty good development over the last month or so, and where the policy continuity also lends a lot of comfort for us. And in that sense, we continue to remain very constructive about the markets from a medium-term perspective, medium to long-term perspective. And there are tailwinds and there are some headwinds, but as long as we can stay bottom up, there are a reasonable amount of opportunities that we are able to identify today, and which is where our outlook for the year is moving from narratives to execution. So I think the period between 2020 and 2024, we had a lot of narratives in play in the markets. I think we have come to a phase where narratives now need to move on to execution, and which is where we are focusing on companies that can deliver that for our investors, and hence we're staying very, very bottom up. And these are few of the sectors that we are positively overweight on and underweight on. These are all outcomes of our bottom up research and portfolio construction. These are not top down views that we've kind of taken. So in that sense, this is more an illustration of the what's the shape of the portfolio rather than anything else. That's broadly what is there. Thanks a lot, everyone, for the opportunity. Thanks, Kamal. Thanks, Aishwarya. I'll stop here.